Good morning from London. I'm Anna Edwards alongside Kriti, Gupta and Lizzy. We're an hour away from the opening trade. Here's what you need to know. Sales of fashion and leather goods at LVMH dropped for the first time since the pandemic as the luxury sector's biggest player is hit by a slump in demand from China. The company's US-listed stock drops as much as 10%. Meanwhile, the chips are down. ASML shares see their biggest daily drop in 26 years after missing its latest order estimates and lowering next year's guidance. Nvidia and other chip-related stocks also dip on the news. Plus, Donald Trump defends his tariff plans and dives into the details of his economic platform in a Bloomberg interview 3 weeks ahead of the US election.
A very good morning. Welcome to Wednesday. Checking in on these markets, we have mostly European futures pointing lower as we await that read across from the LVMH earnings and ASML weighing on tech stocks yesterday. But the FTSE 100 pointing a touch higher, 108 on euro dollar as we await that ECB meeting in Slovenia tomorrow. And Brent trading slightly higher after a 4% drop yesterday as Israel says it's going to make its own decision on how to attack Iran. The opening trade, countdown to the opening trade, starts right now.
October the 16th, we are about 21 days away from the U.S. election, and yet geopolitics rocking the headlines for some of Europeans' biggest heavyweights. We're going to dive into the story for the rest of the program. Welcome to the opening trade this morning. But Anna, let's kick it off with some breaking news.
Yeah, absolutely. Let's go straight to the CPI data out of the UK. And if we were looking for a green light for the Bank of England to cut once again, perhaps in November, then maybe we just got that. We certainly have some weakness coming through, Lizzy, in this CPI print. 1.7% is the number. The estimate was 1.9. We're back below 2%. You know, that's been something of a story for the UK, getting back below that 2% level. The services number stands out to me as being particularly interesting as well. I know Bloomberg Economics were looking at this. That's dropped down from 5.6% to 4.9%, coming in well below that 5.2% estimate.
Yeah, the core number also below estimates as well. This compounds the jobs data yesterday. Positive news on wage growth, again giving the Bank of England that green light. So Andrew Bailey, remember, had dangled this carrot of saying that there could be more aggressive rate cuts if the data warranted, and indeed it looks like they do. But inflation could rise again before the end of the year, don't forget. Economists seeing 2.5%. I also want to talk, Anna, about the LVMH earnings yesterday. Real disappointment here from Europe's second largest company by market value. Analysts had actually expected a gain when it came to sales for its fashion and leather goods unit, of course its biggest unit, but you saw sales unexpectedly falling for the first time since 2020, and it comes back to the China story, which is going to be a theme throughout the earnings conversation. It's not just China, though, it's also Japan, and that perhaps a bit of a surprise. Now the question is, what does it look like beyond the period when Beijing stepped in with the stimulus?
Yes, so exactly, and the CFO saying it's hard to assess the impact of that stimulus, actually, and that's still an open question, isn't it, for everybody. We'll get a proper debriefing at the end of tomorrow, I think, for that sector. But how does all of this add up to the consumer? You know, Beijing's not doing these things to sell more handbags. That's not necessarily the aim, but what will the impact be there? Interesting, though, Kriti, because it wasn't only China, and it also wasn't only fashion and leather goods, but that is where a lot of the focus is. That sector saw a drop in sales, and they haven't seen that since 2020, and before that, 2009. So this is quite a sort of shocking level of underperformance.
Yeah, is this a recession indicator, perhaps? At least it feels like that on the surface when you look at those historical norms. I'm going to come back to Lizzy's point here, which is that, of course, the China piece is such a crucial component to LVMH's bottom line. 26.4% makes up for just Asia revenue, taking out Japan, of course. This is massive, and this is without the geopolitical impulses as well. Anna, to your point, this is not just an LVMH story. This is hitting ASML as well.
Yeah, absolutely. The geopolitics certainly does hit ASML, doesn't it? But yesterday, what we saw hitting ASML was a technical error in the sense that they released their numbers earlier. But the actual detail of the report is, I should say, what moved the shares. The guidance dropping for 2025, and you can see why when you look at what they reported for the third quarter. So the bookings coming in well below estimate. We saw the stock down as much as 16% in session yesterday. today. Will we see a continuation of that, or will there be room for a bounce, given that a lot of the nerves might have been added to by the fact we got this technical error and the early inadvertent release? What's also interesting here is we don't have a huge amount of explanation yet, because normally you'd get these numbers this morning and then the investor call later today. Well, we still have to wait for the investor call. That still hasn't happened. And so what we really want to understand here is how much of this is about autos and industrials and that slump in those consumer-facing businesses, or those businesses we've known have been weak, and how much of this is an AI story, because it's a little difficult to discern right now.
Yeah, and how much is it about tariffs, which was obviously part of the conversation that our editor-in-chief had with Donald Trump?
Yeah, it certainly is one. Before we get to that, though, we should talk about the fact that 26% for LVMH, 47% of China's third quarter sales, ASML's third quarter sales came from China. So again, almost half of those sales under pressure at a time when the Dutch government is already adding pressure to ASML in terms of moving their listing to London, in terms of hiring more foreign labor to really increase and compete on a global stage. So not only is it a geopolitical story for ASML, it's also a very, very close domestic one, which brings us nicely to what Lizzy was just talking about in terms of where we lie on the U.S. election front, simply because that's going to maybe change the game for so many of these European companies. We spoke to Donald Trump, the former president, and of course Republican candidate, at the Economic Club of Chicago, a conversation with our very own John Micklethwaite. Take a listen to what the former president had to say when it comes to tariffs and taxes.
We're all about growth. We're going to bring companies back to our country. We're going to lower taxes still further for companies that are going to make their product in the USA. We're going to protect those companies with strong tariffs, because I'm a believer in tariffs.
How do you fund the tariff story if you start to actually penalize companies around the world for not producing in the United States? What does that serve? And he makes the argument that it serves potentially the deficit, but also the tax cuts that a lot of people are focusing on Wall Street.
Yeah, he sees this as he sees this as a revenue measure if it doesn't encourage businesses to relocate in the United States, or he sees it as a tool to encourage them to relocate in the United States. Plenty of economists point out at the flaws in this, what it does to inflation, who eventually pays, how much does this end up sitting as a consumer bill, what retaliation we see. And Lizzy, that's a really interesting one, given we have a story overnight talking about Europe drawing up a list once again of targets they would retaliate if needed.
Yeah, and could the EU-US story actually be as significant or more significant than the US-China story? You see the dollar hitting its highest in 2 months off the back of this. John did put it to him that, the amount tariffs are expected to raise is a drop in the ocean compared to the revenue he needs to raise. But Trump sticking with his love of the word tariff throughout this conversation.
Yeah,
No, go for it.
Yeah, no, I was just going to talk about the guests that are coming up on the programme. We will tell you, we should tell you what is coming up. We will be talking about what all of that adds up to for the dollar. We'll speak to Rabobank's Jane Foley, who'll join us shortly. That's a G10 FX conversation at 7:30 UK time. We place ASML in the geopolitical context. We'll speak to Francesca Giretti. We will also be joined by Maximilian Uleer from Deutsche Bank, who will be with us to talk about equity markets at 8:30 UK time. AIB Group CEO Colin Hunt talks rates, buybacks and Ireland's economy.
Plenty more to watch on the docket today as well. I find like maybe some headlines coming out of Brussels today where the EU Gulf Cooperation Council will be meeting. So we do know that Mohammed bin Salman, by the way, of Saudi Arabia is actually in Brussels right now meeting with some of these EU leaders. We're going to have coverage for not just today, but through the rest of the week as well. At 12 p.m. UK time, we get some more U.S. data. Those MBA mortgage applications are going to be hitting the wire. But I would argue maybe the bond market keeping an eye instead on Atlanta Fed President Raphael Bostic's conversation. He will be speaking later today. But then all in the lead up, maybe after the lead up, to Morgan Stanley, those earnings coming out. It's the last of the bank haul. We got Goldman, Citi, et cetera. In the last couple of days, we'll see if Morgan Stanley matches the trend. Anna.
Yeah, absolutely. We will see if Morgan Stanley matches the trend. And in terms of the banking sector, we've got, we saw a lot of volatility playing out favourably for banking stocks yesterday, didn't we? Citi, Bank of America, Goldman Sachs, stocks traders racking up a record third quarter. You draw our attention, though, to the other story around Citi, which was really important, Kriti. The fact that they started the day talking about the strength of their performance, and by the end of the day, they were having to deny that their business faced an asset cap. And this is linked to various fines that the company has faced in the past, and a lot of analysts then joining the dots between other businesses that have been fined and asset capped. Now, Citigroup really keen to point out they are not, but the message took a while to land, and in the meantime, some damage was done to the share price.
Absolutely, a 5% decline in yesterday's trade. That is a big deal for Citigroup that's really already been trading from a lower price-to-book ratio as well. So that's going to be one that we keep an eye on. But it really comes down to what Jamie Dimon does not want to talk about, which is that net interest income. And it still seems on that front you are seeing wins across the board, except for, to Anna's point, Citi, Lizzy.
But look, the KBW Bank Index and its third day of its winning streak yesterday, outperforming the broader market. Is that because actually of the woes at ASML? We continue to monitor that messaging from the bank bosses, kind of reinforcing actually the soft landing narrative. But let me take you through some of the other stories that you need to know this morning. The world's two biggest suppliers of iron ore, Rio Tinto and Vale, both raising output last quarter, even as China demand remains a risk. The price of steelmaking material has fallen almost 25% in 2024. In other news, Italian Prime Minister Giorgia Meloni's cabinet is tapping the country's banks and insurers for €3.5 billion to help finance its budget. The new plan is designed to deliver on the giveaways pledged to voters, but still needs to be submitted to Parliament for sign-off. And the most volatile quarter since the pandemic has delivered a windfall to Wall Street's trading desks. As we were discussing, the likes of Goldman, Bank of America, Citi and JP Morgan all posted equities and fixed income trading hauls that beat analyst estimates. But Citi's net interest income and margins fell short for the street. As you said, Kriti.
That's certainly something to keep an eye on. In the meantime, we're getting some trade gate pricing coming out for LVMH as well. Already early pricing around some of that hit that it took. But when you look at the numbers here on trade gate, falling 4.8%, Anna, relative to the trade. Looks like some pain for the shares, but also maybe for the French index broadly.
Yes, pain for the French index. And we'll see what that does to other, because the ADRs of Caring were also weaker. I should say, though, I mean, the ADRs were down as much as 10%. So if this is the reaction we see in Paris after some due consideration and overnight to think about it, then maybe not such a bad performance. Maybe some of the weakness in China continues to be priced in. Maybe some people still have that expectation that the China stimulus will do something for the luxury sector, and we'll have to see how those dots are joined. Coming up on the programme, we'll check in on the global chip rout and discuss the role of geopolitics and trade wars in it. Plus, we'll watch out for the luxury stocks at the open after LVMH takes a hit from dropping Chinese demand. Up next, Donald Trump says the dollar is secure. We will be joined by Jane Foley, head of FX strategy at Rabobank, to discuss that and talk about the broader markets, get an update on the euro, perhaps also think about where the UK goes with that real weakness in CPI. No doubt she'll have some views on the pound. If you have any questions, you can get in touch with us. IB plus BBTV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
I think it's the greatest job in government. You show up to the office once a month and you say, let's see, flip a coin. And everybody talks about you like you're a god. Oh, what will he do? I think that if you're a very good president with good sense, you should be able to at least talk to him. I don't say make the decision at all. If
you worry about that?
The dollar is so secure, your reserve currency is the strongest it'll ever be.
Republican presidential candidate Donald Trump, former president, of course, speaking with Bloomberg News editor-in-chief John Micklethwaite, giving his views on the Fed and how difficult or easy, in his view, it is to set Fed policy. Also on the dollar. We'll return to the dollar in just a moment. Should we go back to some of the other news we've had out this morning on the UK? Because these are all adding up to important things we need to have in our next conversation. But, Lizzy, we were just reflecting on the weakness of some of this CPI data. 1.7% then on CPI for the UK. You know, we're nicely below the target that the Bank of England has. So is this enough of a green light for the Bank of England to cut once again?
I think the fact that it's below the expectations, not just at the headline level, but also core and services, specifically services, is going to be really encouraging to the Bank of England. On top of the jobs numbers yesterday, you've seen the pound weakening against the dollar by 0.5%. 130 is where we're trading at the moment. So we'll await the changes in pricing at 7:30 a.m. But it looks like a dovish reading, of course. And this is for a data-dependent bank that's been, at least the governor, dangling the prospect of more aggressive rate cuts. So it looks like Andrew Bailey's got what he ordered.
OK, let's put that to Jane Foley, Head of FX Strategy at Rabobank, who joins us this morning on set. Let's start with the pound then, Jane. Very good morning to you. I mean, so is this the green light for the Bank of England? Do we get more cuts than we previously priced? It seems the pound has reacted. Rates markets taking their time to work out whether this means more cuts or not.
Well, good morning. You know, I think the second part of your question is perhaps the most interesting because, yes, I think we've got the green light for a November move, a 25 basis points move. But services sector inflation, yes, it's come down and maybe it's below forecast, but it's still a long way above 2%. It's still uncomfortably high. And so the question, I think, rather the uncertainty is there enough really to see a second 25 basis points cut this year? And at the moment, perhaps not. I think we need to see perhaps more labour market loosening because, yes, we saw wage inflation come down in yesterday's report, but even that, you know, it's still quite high. The labour market is still quite tight. So 25 basis points in November, yes. I think there is a green light for that, but I'm just not so certain yet about whether or not there is enough signs that inflation genie is back in its box to signal that they can pick up the pace. And, of course, that's in contrast with a number of other central banks right now.
Right, yes. And yes, it's interesting, isn't it, to contrast across the Atlantic, the conversations around whether inflation, you know, has been underestimated in the US a little bit, whereas here in Europe we seem to be talking about this inflation, you know, green light for rate cutters. In terms of the broader story then in the UK, of course, we're waiting for the budget. How does the budget link into your expectations around the Bank of England?
You know, I think the budget is crucial because I do sense that in the way up to the July general election in the UK and afterwards, there was a sense of optimism, a sense that the Chancellor understood the need for investment in the UK in order to raise productivity and growth. But, of course, the Chancellor is very much confined by the fact that debt as a percentage of GDP is close to 100% of GDP. We know that tax rises are coming. We know that investors are concerned about the capital gains tax potentially and potentially also about an employer's national insurance contribution. And so what sort of line is the Chancellor going to walk between trying to boost risk appetite and actually tax potential investors? So we know it's a difficult way, and I do sense that honeymoon period that we had, this optimistic period that we had around about the election, has really begun to sour. And I think it's the onus is really on the government now to try and keep that optimism up. So yes, I think sterling can still outperform the euro, largely on the euro's woes. But I do think that cable is going to struggle to get back to the highs that it was at just a few weeks ago.
But Jane, what really surprises me is that so many people, so many analysts who sit in your seat are kind of comfortable with the idea that Rachel Reeves would change the fiscal rules in this budget. And it's all seemingly down to the vibe. You know, why should we trust the Labour government to move the goalposts any more than Liz Truss did in her mini-budget?
You know, I think with Liz Truss specifically, it was the idea that there could be spending, there could be tax cuts, and they were completely unfunded. And I think there was a confidence issue there. I think it's going to be very interesting to watch the gilt market over the next few weeks before the election and before the budget and after the budget to see how that gilts market reacts, because she does have to sell quite a difficult picture. And we have seen the Labour government trying to sell the picture. It's okay to borrow if it's used for investment. Now, if they can pull that off, if they can reassure the gilts market that that's what they're going to do, then they're going to be able to do it. But I think how the gilts market specifically judges that rhetoric is going to be crucial. So I do think, gilts are going to be quite interesting, potentially.
But, Anna was asking you about the pound, whether it's seen its best days, Andrew Bailey being pretty dovish in his comments to The Guardian. How does it tie in with the budget, and how much would Rachel Reeves have to do to really shock the market, in your view? Keir Starmer saying that raising capital gains to 39% is wide of the mark, but where's the limit, in your view?
Well, we've got to say that interest rates potentially coming down is obviously a softener in terms for investment. So if interest rates can come down further, then obviously in terms of overall sentiment, then that's going to offset some perhaps of the souring sentiment for tax hikes. So I think it's the overall package. I think the market really does need to judge how the overall package is. We've had the CBI, for instance, this week indicating that, tax hikes, everyone knows that they're coming, but if there can be put forward a credible projection in terms of investment and growth, then that might be more palatable. So it's going to be the overall story, I think, that's been sold, and it's going to be a very, very tricky line. I think we all understand that.
So October 31st, what happens November 1st in terms of how tradable the budget actually is? I'm looking at 130 here, even with these numbers around inflation and the budget, et cetera, you're still seeing the market positioned long pound. Why? And how long does that last?
So, in my view, this is part of a long-term recovery. We've got to remember that cable was at the weakest level ever at the tail end of 2022. So that was after Liz Truss. So last year, it was the second best performing G10 currency. This year, in the year to date, it's the best performing G10 currency. But if you look at long-term averages for cable, well, they're closer to 150, like 152, 153.
Yeah.
So what we've got is not necessarily a strong currency in a historical sense, but we've got a currency that I think is just getting back on its feet. And certainly more political stability. Now, we had that, last year as well, 2023, as well as 2024. That's all feeding this position. But I do think, now that we've got this position of the dollar coming back, that trying to get to 134 in the next few weeks, the next few months even, is going to be a lot tougher than it was just a few weeks ago.
What about relative to the euro then, especially ahead of this ECB meeting? The pound, to your point, has outperformed even the euro, despite perhaps these questions around the fiscal handcuffs that are frankly on both sides of the English Channel. What's the performance look like year end into euro sterling?
I still prefer sterling to the euro, and this is because we've got a German economy still mired in stagnation. It was supposed to recover in the second half of this year. It's not doing that. We've got this movement towards populism, towards the far right in Europe. We've seen that very much in France. We've got France's budget issues. If a budget is pushed through, hopefully it will be, that will probably constrain growth.
But how much of that is in the price?
Well, the euro, in my view, one of the biggest stories of G10 FX this year has been the resilience of the euro. It's still the third best performing G10 currency after the dollar and after the pound, despite all of these woes, particularly Germany's woes. And I would imagine that there are a number of big German exporters right now who would be very happy to see a weaker euro dollar because they're facing a weak China. They've got concerns still about energy. They're still working their way through that energy transition. They no longer have very cheap energy coming from Russia, and they've got a much tighter labour market than they had a decade or so ago.
Just quickly, Jane, I want to ask your take on this Trump interview we had with our editor-in-chief. It sent the dollar to a two-month high, his comments specifically about tariffs. If his policy is inflation, how soon do you expect the Fed to turn to hiking?
Well, our view is that if a Trump presidency, if he comes into power again, the Fed could actually end its easing cycle by January. And then we could have steady rates, but perhaps the year. That's assuming we get tariffs next year. Obviously, the fiscal changes are going to depend on Congress. They could take longer to push through. But it could mean that the easing cycle, at least, is over very quickly.
Certainly something we keep a very, very close eye on. These next 3 months are going to be very interesting. Jane Foley, at the edge of her seat, head of FX strategy at Rabobank. We thank you so much for joining the program. Coming up, we are going to talk a little bit about the geopolitics, a little bit about the numbers, but this time apply it to the corporate space. Shares in ASML plunging the most in 26 years when you look at the U.S. ADRs, but also the European shares as well. For the Dutch giants, disappointing outlook. Less than half what analysts expected for third quarter bookings. Brutal when it comes to the chip sector. We're going to talk about the ripple effects, the geopolitics behind it, maybe how the chip sector can rescue itself out of all of this. We're going to bring you the details next, plus, of course, how this all trades at the open just 30 minutes away. Stick with us. This is Bloomberg.
From Nvidia to ASML, Tokyo Electron to TSMC, the highest of high-tech chip firms are caught, ever more directly, in the geopolitical crosswinds between Washington and Beijing. The stakes could hardly be greater, with America and its allies increasingly fearful of Chinese advances that might give it crucial technological and military advantages. From design by the likes of ARM and NVIDIA, to equipment from lithography powerhouse ASML, to materials to make the chips from the likes of Global Wafers, and manufacturing by the foundry giant TSMC, the global supply chain winds through many countries considered geopolitical hotspots. US attempts to box in China haven't always been successful. And it's not just the parts themselves. The Netherlands has curbed ASML's ability to maintain its high-end lithography machines in China, which could render some of them inoperable next year. Still, with such vast and intertwined supply chains, slapping restrictions on high-tech is harder than it looks. And then there's the risk of Chinese retaliation.
That risk of retaliation maybe showing up in ASML's numbers already. The stock, of course, plunging in yesterday's session after really only booking less than half what analysts expected. Some brutal numbers that are already being reflected in the way the chips shared. Let's bring in Tom McKenzie, who, of course, voiced that package around the geopolitics. This was not a good number, and not a good number by a really big margin.
I think brutal is fair. As you say, below half the estimates, 2.6 billion euros in terms of sales in the most recent quarter. The expectations have been for 5.4 billion, and crucially as well, downgrading their forecast and their guidance for 2025. They had seen for 2025, for that period, fiscal 2025, around 40 billion euros of sales and shipments. Now they see that at around 30 to 35 billion. The relatively newly installed CEO, I should say, Christophe Fouquet, saying that the recovery, and I'm quoting, is more gradual than expected. It will continue in 2025. Customers, he said, are cautious. And amongst the customer list, Intel, we know, is cutting back in terms of its foundry and factory build-out. So that is a potential impact there. But also SK Hynix and Samsung, two other crucial customers for ASML and their lithography machines, becoming, they have said, executives at ASML, more cautious.
Very, very scary kind of precedent that they're setting for almost every company now that's not even in the chip sector, but exposed to China in some way. Tom, don't go anywhere. Stick with us. I want to bring in another voice here. Francesca Goretti, research leader over at RAND Europe, joins us around the table. Francesca, Tom just outlined how you're seeing geopolitics quite literally priced into this bottom line. From your perspective, how serious is that threat, or is this something that is hard to act on?
So it's actually relatively serious in the sense of the first few months where we saw these policies emerging in terms of export controls and etc. We were wondering how much of an impact it would have had on supply chains globally, and we didn't have the numbers to be able to assess that. Now we have some numbers, and we're seeing that they are indeed reshaping the supply chains, especially in semiconductors and chip. There are a number of reports that point out at the fact that, for example, US suppliers struggle to find new clients. And the same clearly is happening for some of the European suppliers in terms of ASML as well. But at the same time, we also see that China struggles to find new suppliers. So there's definitely being an impact in the global supply chains.
So we're seeing this play out in the global supply chains, Francesca. Policy isn't the same in the US and Europe. And so how should we understand the differences there and the impact that those policies are having?
So policies are not the same for sure, but there has been a growth of alignment between the US and the European Union, especially with the cabinet of Ursula von der Leyen, which is going to be there for another term, right? Now, of course, the Trump card is a bit of a question mark. Yet there are some substantial differences, and the substantial differences are around China. The US is not afraid to target China directly with these policies, while when it comes to the European Union and European actors in general, they tend to have a country-neutral approach. So they adopt policies that are actually applied to everyone, even though deep down China is the main concern. And this will continue to be a point of tension between the US and the European Union.
I mean, I'm looking at the Dutch policy, of course, because that's particularly relevant to ASML, and wondering whether it would be better if the EU took a leaf out of that playbook.
It would be great. There's a bit of an issue which has to do with the mandate that the EU has. Member states are the ones that are going to implement policies such as export controls, investment screening. So in theory, the European Union has a mandate to increase the number of items that are present in the annex for export controls. But the reality of things is that it's really up to member states to decide how to implement them. The result is that the Netherlands will have different export controls than the other 26, for example, unless they coordinate.
I mean, we were talking about the potential for the EU's retaliation to Trump tariffs to, be really significant, perhaps as significant as the US-China trade tit for tat, do you think that it would be more disruptive or potentially as disruptive?
I think it could be more disruptive, definitely as disruptive. What has been keeping a large part of the supply chain together is also the fact that the EU has been trying to play this balancing act and trying to occupy this middle ground between where the US wants to go, where China wants to go. Now, middle ground is not entirely correct. It's obviously more towards the US than towards China. But if the US and Europe as well start to have trade issues and tensions, then of course supply chains are going to be impacted massively, and we're going to see quite huge disruptions.
So, Tom, come back into the conversation here. You've lived in Beijing. You've reported on this live. When it comes to this kind of retaliatory aspect from China, just how much firepower do they have there, given that there's only one maker of lithography machines? There's already a real kind of tightness around who gets their hands on that technology, not to mention ramping up that own escalation. How much kind of decisive ability or pricing power does China have here?
So China, in terms of the extreme ultraviolet lithography machines that ASML provides, is not getting those now. That has been blocked by the restrictions, and it's difficult for ASML to service the machines that are already in place there. In terms of the DUVs, the deep ultraviolet machines, they are getting some of the less sophisticated lithography machines. Those are still being sold into China. In fact, China makes up about 47%, almost 50% of ASML's sales. Look, in terms of the top end, the lithography machines at the top end that ASML makes, China is not able to produce those. They're working very hard on a coordinated basis with a lot of funding to try and close the gap, but most experts think that that gap is probably around 10 years. These are highly sophisticated machines with incredible numbers of components and sophisticated supply chains that goes into producing just one of these extreme ultraviolet lithography machines. So the weakness and the vulnerability certainly is there for China. They have shown some progress, of course, in chip making, and Huawei is central to that. And when you speak to the executives at the heads of semiconductor firms in the US and in the West, they point to Huawei and HiSilicon, which is the unit within Huawei, in terms of the real potential competitive threat there. We should also watch for any potential additional measures coming out of the Biden administration or the next administration in the US around some of the legacy chips, some of the older chips, because that's where China is producing and producing at volume and shipping heavily into the European market. And that potentially is another source of concern. They are used in things like autos, in the industrial sector. That is where China has a competitive edge and is producing effectively. So that could be another option, and that would be pretty seismic if the US reaches for that. The raw materials are a component. You have all the different suppliers in terms of the lenses and the chemicals that come from countries like Japan and South Korea. The raw materials that go into some of these units, some of these products, some parts of the supply chain, of course, come from China as well. So it does have that potential point of leverage.
Yes, and that's a really interesting thought to take me into my next question to Francesca, because you said something intriguing in your notes, and maybe Tom talking there just made me realise why you say it a little. You're talking about the context here, the geopolitical context, but saying that this is not a trade war between the EU and China. Help us understand why that's the case.
The reason why I'm saying it's not a trade war is that both, currently at least, the EU and China, are engaged in a... they're trying to solve the situation.
And there's still a lot of trade happens between the two, even in tech, even in chips, as Tom was just suggesting.
I mean, if we look at the 2023 data, we see that actually the European Union has increased its imports from China, right? So we talk about the risking often, but what does really the risking mean? And we haven't seen that in numbers in terms of what is happening from the European Union. And what we saw is that the numbers, when they did decrease, was actually China trying to de-risk from the European Union to third markets. But the reason why I'm saying it's not a trade war is exactly this. The two of them wants to maintain a relationship for different reasons and with different timeline. China is working towards reaching self-sufficiency if it manages to, when it manages to. The EU needs to keep a linkage with China and with other global actors in order to feed its economy. It has a growth issue. It has a competitiveness issue at the moment. Currently, both of them are engaged in trying to solve the situation. That is why you have all these preliminary tariffs, all these warning signs, because they do want to try to reach an agreement.
So you talked about how the tariffs are already rerouting supply chains. In the longer term, where does this rising protectionism leave the global economy?
That is a great question. It's a bit difficult to say in the sense of that if you just look at what is happening now, you see fragmentation happening, but you also see a true impact on growth in general, because what I mentioned before, so suppliers struggle to find clients, clients struggle to find suppliers. And you see it with very simple examples. You have some of the South Korean suppliers into the US market that are really struggling to replace some of the elements that they were supplying from China. And so even though you have these very strict policies, there are always, at the moment, we have ways to work around them, to have sort of a soft approach to these policies. If there were to change, if we were to see a very hard approach from the US and other actors, then that would definitely disrupt global growth and it would disrupt the economy, global economy as we know it today.
Tom, we focus a lot in this conversation on the geopolitics, which makes sense because this is a sort of background theme that's been building over months and years. In terms of what we know about ASML, and you touched on this a moment ago, you know, clearly a big shock to the markets, but we're waiting for more detail, aren't we? And that's still to come later on today, because normally you'd get this release this morning and then an investor call, but the release came early and we still haven't had the investor call. And it seems there's a bit of confusion in the markets right now as to how much of this negativity is around the AI trend and how much of it is actually around old school auto demand, industrial demand, and things that we, you know, would recognise from decades ago.
That's absolutely right. And so that's where the call is going to be really fascinating, because will they break out the numbers in terms of the EUVs, the extreme ultraviolet lithography machines that are needed, for example, for AI accelerators produced and designed by the likes of NVIDIA, versus the industrial autos. In the statement that came out with the release yesterday, Christophe Fouquet said it was the industrial autos. He said he didn't see significant weakness in terms of that AI demand. That's why NVIDIA dropped, but not as much as some of the other semiconductor players. It is really important to carve out the AI, generative AI, accelerated AI chips from the demand around industrials and autos, because if you look at TSMC sales, if you look at the spend from hyperscalers as they project into 2025, as you look at the Morgan Stanley note when they went on the ground into NVIDIA and said they see forward guidance in terms of the demand for the Blackwell into 2025, all of that suggests the demand is still there for AI accelerators, which is just one slice of the pie for ASML in terms of providing the equipment that produces those.
Yes, you wonder how that complexity develops as we go through the day. Thank you very much to Tom McKenzie, of course, covering technology for us. Francesca Gueretti, research leader at RAND Europe. Thank you very much as well for bringing us the more on the geopolitical angle. Lizzy, let's do a little more on the UK.
Yeah, of course, we had the CPI numbers at the top of the hour. We are seeing the pound trading below 130. This is the first time it's breached that level since August. It's weaker 0.7% currently. We've also got the latest BOE bets. So we're back to 24 points of cuts being priced in for November. But what's really interesting is December. Jane Foley pointed to this. They're now pricing 42 points of cuts by December. That's up from 34 points before the CPI reading, and bets ramping up beyond that too. So 125 basis points of cuts now seen by August next year. So this CPI print having a very dovish effect on the market.
OK, let's move on to other matters. Donald Trump says his economic policies will boost growth and bring companies back to the United States, despite economists predicting, well, otherwise. The Republican presidential candidate says he'll offset trillions of dollars of tax cuts by raising tariffs on imports. He spoke to Bloomberg News editor-in-chief John Micklethwaite.
Because we're about growth. She's got no growth whatsoever, and we're all about growth. We're going to bring companies back to our country. You look at even today, as I was driving over, I see these empty, old, beautiful, like steel mills and factories that are empty and falling down. Some have been converted to senior citizens' homes, but that's not going to do the trick. And we're going to bring the companies back. We're going to lower taxes still further for companies that are going to make their product in the USA. We're going to protect those companies with strong tariffs, because I'm a believer in tariffs. I'm not sure that you are. I don't think you are, but I congratulate you on your career. But to me, the most beautiful word in the dictionary is tariff. And it's my favorite word. It needs a public relations firm to help it, but to me, it's the most beautiful word in the dictionary.
Tariffs, do you think that will bring in the revenues? To use another bipartisan group, Peterson Institute, they say they only bring in $200 billion. That is that's barely the cost of 2 of your promises.
Yeah, but that's like, for what company are you talking about, okay? Look, I brought in with tariffs, and I was just getting started. Then COVID came, and we had because I tell you what, I did a very good job in COVID. Nobody knew what the hell it was. I call it the China virus because I like being a little more accurate. But when that came, but we got hundreds of billions of dollars just from China alone, and I hadn't even started yet. But tariffs are two things, if you look at it. Number one is for protection of the companies that we have here and the new companies that will move in, because we're going to have thousands of companies coming into this country. We're going to grow it like it's never grown before. And we're going to protect them when they come in because we're not going to have somebody undercut them.
Donald Trump sending the dollar to its highest in 2 months in conversation with the Bloomberg News editor-in-chief, John Micklethwaite. Coming up on the programme, falling out of fashion, we're going to look at LVMH's sales miss and why it could be leading the luxury pack. That's it, Stocks to Watch next. Stay with us. This is Bloomberg.
Welcome back, 7:49 here in London. We have 10 minutes or so to go until the start of the European Equity Trading Day. Let's get a perspective on these markets. Our Markets Live executive editor, Mark Cudmore, joins us now with more. Mark, let us start. Shall we start with what we've learned around the chip sector and what you see as lasting and what seems to be short-lived? The Asia markets seem to be held back by what we heard out of ASML yesterday.
Yeah, obviously, that was a real kind of shock to the system, so integral to the whole kind of AI theme. But I think this is where it's misunderstood. This is a company which has kind of exploded on the AI theme, and yet the negative news yesterday was nothing to do with its AI parts of its business. And I think we generally feel that, you know, all the indications we've got for the AI sector is still very positive going into this earnings season, and we think earnings will still deliver on that. And so therefore we think that the pullback in Nvidia and other related names is probably not sustainable, and we'll see a recovery in those names going into at least this earnings season. Even though the AI theme we know has run a long way, these stocks are very expensive. This ASML story is the wrong reason to fight it right now.
In terms of some of the way you trade these geopolitical tensions, trade the tariff threats that are coming from, well, frankly, both sides of the election campaign, is any of it tradable until, say, November 6th?
It's a great question, Kriti. Actually, one of the things I'm wondering is, you know, we saw that the interview yesterday where Trump, you know, talked about tariffs being a beautiful word. And the impact was relatively minor. There's a little bit of dollar mex, not much in dollar yuan. I wonder how much is the dollar already pricing in some expectation of tariffs. And I do wonder, you know, we know that the world is structurally long the dollar. It's expensive at the moment. If we get a Trump presidency, and I wonder whether the kind of post-result rally in the dollar might be something that fades very quickly. In the same way that 8 years ago, there was this assumption that Trump would be negative for stocks, and that lasted only for a number of hours before it reversed rapidly and ended up being very good for stocks. I wonder whether there's a slightly different dynamic this time where everyone assumes it's going to be positive for the dollar, but maybe in the hours or days after a result, if Trump wins, that actually ends up being the peak for the dollar, because the dollar is already expensive. It's already pricing in the likelihood of tariffs. And I think the negativity on US trade, US companies might be more damaging for US flows.
Mark, just finally, we've seen the pound slipping below 130 off the back of the UK CPI print this morning. Do you see a December rate cut? Because that seems to be more the question than November.
Look, I think generally UK rates cuts are underpriced. One of the themes we've talked a lot about in the show, Lizzy, is the idea that, you know, over the last month, we're seeing a little bit of tightening of this theme, but the idea that US rate cuts were completely overdone, completely bonkers. I still think there's more rate cuts to come out of the US curve. And meanwhile, I think UK rate cuts are underpriced. And I think there's still more convergence to go in that theme. You know, exactly which month they cut is a minor quibble. The point is, UK two-year yields have downside, US two-year yields still have upside.
Yeah. Bloomberg Markets Live executive editor Mark Cudmore, we thank you so much. You can get more up-to-date analysis from him and the team. Just type in MLIV Go on your Bloomberg terminal. Let's go from the macro to the micro. Joe Easton with our stocks to watch. Joe.
Morning, Kriti. So luxury clearly going to be a big focus for the markets today, following that bit of a shocking report from LVMH after the close of trading yesterday. Here's what's happened to the US ADR in the late trading. We can see it dropped almost 10%, then recovered slightly to down around 7.9% on the session. In terms of the impact, this was a good quote that stuck out to me. Bloomberg Intelligence describing it as a multi-sector miss, which is harmful to the luxury sector in general, i.e. this wasn't just one part of the business. It was jewellery, it was clothing, it was handbags, and it was also drinks. All of those parts of the business were weak. So we're going to keep an eye on a swathe of stocks. We could have put about 20 stocks on the screen, but we're going to look at the likes of Richemont, Kering, Burberry, and also, importantly, the drink stocks as well. Remy, Pernod, Diageo, Campari down heavily, but potentially not getting as much attention. But that could be one part of that sector to watch today. Then in terms of a bit of a better report, we have got numbers from Adidas. Now they are upgrading their earnings guidance for the third time this year as they continue to recover from the fallout with their relationship with Yeezy, aka Kanye West. We can see, if we remember back in 2022, the top stock really tanked following the breakdown of that relationship, but they're selling more of that stock now, and also lots of the Samba trainers that we all love as well, so that could be a boost there. Over in France, we have got a profit warning from Rexel. That's in electrical components. Do keep an eye on that one. A lot of that is tied to the auto space as well. And in terms of your ratings changes, we've got L'Oreal over at JP Morgan getting a downgrade. Boliden in mining also cut, and Teleperformance gets an upgrade this morning.
All right, Joe Easton, our equities reporter, we thank you as we look ahead to the market open. But coming up on the programme, we will take you through that market open. We've got futures pointing lower, of course, in Europe as we await the impact of the LVMH earnings and a read across from ASML. So do stay with us. We'll have plenty more. This is Bloomberg.
Welcome back. A few minutes to go until the opening trade. This is the picture. This is the handover we have from Tuesday's session. It was very dramatic at the end of the European session. You can see the drop in the white line there. That's the end of the European session in US times. And that's when we saw that news come out, inadvertently, it would seem, from ASML. That weighed on the tech stock here. That stock down by 16% in session. Is there room for further weakness on the tech theme today? It was the worst performing sector in Europe yesterday. Or is there room for a little bit of a change of direction there? It weighed on the US session, as you can see in the blue, which continued to lose steam. But we have a lot of questions, Kriti. We still don't know a lot of the detail around that ASML number. To what extent is this about the AI theme, and to what extent is this about autos and industrials, and something that we very much more understand and seems a little more old school. Anyway, all of that plus some news out of the luxury sector will be building into the futures picture for Europe.
It absolutely will, and you're going to already see that by just the pain that you are seeing some of these futures indications. I'm going to start from the right here because the most negativity from ASML showing up already in those Amsterdam futures, down whopping 2.5%. Take the China story, feed it into the luxury story as you were talking about, a whopping 1.2% decline in the French index. Outperformance, however, in the UK, we'll see how much, Lizzie, that sticks at the opening trade.
Yeah, that French story, of course, comes down to luxury. We had the LVMH earnings, so there's a stock to watch at the open. Bad news across its goods, across countries, but especially China, especially its best unit. Remember, luxury stocks make up nearly 10% of the Euro Stoxx 50. You've got Kering down in the pre-market at 2. Mind Burberry as well. Adidas, one to watch, flagged by Joe Easton as we get towards the open. And ASML, of course, room for further weakness, we shall see. Anna.
Yeah, absolutely. So the market open just seconds away then. Will we see any room for that positive story out of Adidas to cut through? Maybe not a day for that. The FTSE 100 then going its own way. We've seen a big drop in the pound. That's on the back of the CPI number, which came in weaker. That could mean some positivity at the start of trade. In fact, we see that on the screen this morning. So the FTSE 100 doing its own thing, perhaps a bit of FX read across in the market there. More broadly, the stock 600 down by 0.3%. There will be a lot of focus on Paris. Kriti, as you were saying, the LVMH story really stands out as something we need to focus on. To what extent will that take down others in the luxury sector? We saw that yesterday in the ADRs. It was the 10% drop in the LVMH ADR, but that was also echoed in some weakness, at least in the Kering ADR. So ongoing concern about China and what the demand will look like for luxury products. And even the CFO of LVMH saying they can't be sure exactly what kind of impact the latest stimulus measures will have. So broadly, we're still waiting then for the DAX to open up, still waiting for the CAC 40 to open up. We have a bit of weakness coming through on the IBEX, down 0.1%. I guess there's a lot of views and perhaps some changes of views being expressed in the markets then this morning, Kriti, as we wait for an open in Paris.
A tale of two heavyweights, Anna, except it's really just one tale. When you talk about how this is showing up in the Stock 600, your two biggest movers this morning, right off the bat, in terms of index contribution, is going to be LVMH and ASML. And we're already seeing that, a whopping 7% decline in those shares. Look, we're still waiting to Anna's point about that French index. That's going to be something we keep an eye on. But then we're also going to see how the ASML story is reflected in the Amsterdam index as well. Remember, that is going to be the heavyweight there. Right now, you are seeing down about 0.4%. But when you talk about the downside pressure, it is LVMH, it is ASML. We're throwing Hermes in there as well from a kind of stock mover perspective. But Anna, to your point, you are seeing outperformance in some of the kind of British names as well, or London listed names, I should say. SAP is going to be top of that list, not really getting the message from ASML. Those are two names that usually trade in line with each other.
Right, so the German SAP business, that tech name up by 1.3% this morning, as you see there, and some other heavyweights in London going higher. London does stand out, but Lizzy, you know, there's the FX effect in there, isn't there? And we saw FTSE futures change direction as a result of that CPI print and the big drop in the pound that we saw there. And we still don't have an opening price on the CAC or the DAX. So things taking a little time to open up this morning.
They are indeed, but as it stands, without the CAC and the DAX, you've got energy, the best performer in terms of the sectoral breakdown, higher 0.8%, some of those London names in particular. You've got about a quarter of sectors in positive territory, consumer products and services at the bottom of the basket, lower 2.9%. But as you say, we are still waiting for the CAC and the DAX to wake up and get going and process that impact of LVMH.
The Adidas story is going to be interesting as well. Does it kind of flow into this risk-off sentiment that we're seeing right now across the European indexes, or does it kind of rise above the rest of the gloom and doom? Of course, as we are waiting for some of those numbers to show up, I'm going to really emphasize the fact that from an index contribution perspective, it is those heavyweights, Anna, that are really, again, dragging the entire index down. The outperformers also, however, are showing up in the oil space. I thought this is interesting, given yesterday's session. You did see a lot of the commodity names down. You would think, given some of the numbers coming out of some of the miners and the metals space, that would also be the case today. You're seeing the exact opposite.
Well, oil, one area of stability in today's market. 74.47 is where we trade on Brent. I mean, the story, it's been a very volatile year for oil prices, as we talked about. The direction of travel in recent days has been weakness, unwinding of some of that geopolitical risk in the oil price. We dwelt on that a little yesterday, and added to that concerns around demand. But today, for a change, we take a breather on the oil story, it would seem, and we're pretty flat. Yeah,
so Israel saying that it's going to make its own decision on how to attack Iran, keeping open this possibility that energy infrastructure could be targeted. So as you say, you saw that 4% drop in oil yesterday, but now Brent on the front foot, higher 0.3%, $74 a barrel.
Well, in the meantime, as we've been speaking, we're still awaiting the French index to properly open. The DAX, however, it's opened unchanged. It looks like it's still digesting some of the cross currents we're seeing in this equity market. In the meantime, let's talk about those regional cross currents. We've talked about outperformance in the periphery relative to the core. We asked Bilal Hafeez, the CEO over at Macro Hive, about that very dynamic and whether or not that actually continues. Take a listen to what he had to say.
Some of the factors that are driving the strength in the peripheral Europe is things like tourism. There's certain catch-up consumer demand, which isn't necessarily linked to Germany. And moreover, Germany's weakness is specific to its own sectors that are doing poorly, in particular the auto sector, which is not related to what happens in Spain and Italy. So I do think the periphery could continue to outperform relative to Germany, at least for the next 3 to 6 months. So there could be this period where they don't catch down to Germany.
Macro Hive's Bilal Hafeez speaking to us yesterday about that difference between what the periphery is doing and what Germany's doing, whether Germany can be the drag. This morning, when it comes to the drag in the equity markets, it is all about France, and that's where we're seeing the most pain. The CAC is officially open by about 1% lower. You are, of course, seeing the luxury names really weighing down. As expected on that French index, it is the underperformer of the region this morning. Let's get a little bit more perspective. Maximilian Uleer, head of European Equity and Cross-Asset Strategy over at Deutsche Bank, joins us around the table. You picked a good day to join us. The markets are doing their thing. Walk us through what seems to be the theme of the morning, which is China is the Achilles heel for some of these heavyweights. It's getting priced in as soon as we get these numbers. Is this a one-off?
So I think there are basically two things that really strike, right? That's yesterday's ASML and LVMH numbers, and they're highlighting consumer weakness in China. We think we are far from a recovery there. So we're not yet saying, even though we see the stimulus, that we should be buying into that sector. Too early. We think you first have a recovery in asset prices and then in consumer sentiment and probably a lot later in manufacturing. So that's a theme I think will continue for now. And semis have been weak, and I still think that estimates for next year's earnings are a lot too high. So if you look at sell-side estimates for next year's earnings in the tech space, it's plus 28%. So I think the buy side is actually a lot closer to reality than sell side. So I think sell side needs to still decrease their estimates for next year across the board.
It's not a very happy message at 8 a.m. in the morning. But give us then, and I'm going to flip this on its head because there's plenty of the downside to cover. Is there a bull case in Europe right now?
Absolutely. So I think what's the great news is that those two things are the main drag on markets, and that's been the two biggest companies, or two of the 5 biggest companies in Europe, but they're 2 out of 600 in the stock 600, right? So there's still a lot of other companies going to report with better fundamentals, and we think that earnings will come in 5% higher than people expect. So 5% higher than consensus estimate of minus 1% for Q3. And Q4 even better. Because what's interesting is, yes, the situation is quite challenging, but estimates, apart from semis and tech, are actually quite low. So very depressed. If you look at Q4, we think actually beats are going to be a lot higher. H2 of this year, in our view, is going to be pretty much stable, slightly better than H1. But remember that H2 of last year was really horrible. So we had double-digit negative earnings growth H2 last year. So double-digit positive numbers this year, from a base effect, are quite likely.
So this is really interesting because we started, Kriti rightly pointing to some of the negativity in markets. It's very obvious this week around the ASML story, LVMH story, all of that front of mind for investors. And yet you have quite a positive outlook for 2025. And it's based on a sort of wave of themes picking up through the year. So starting with rate-sensitive stocks, then consumer spending, then a recovery in manufacturing. So if we're looking at tech, and right now, if that is part of the manufacturing wave later on, we're looking in the wrong place, you think, for where an upturn starts?
Yeah, I'll be very selective in those sector choices. We are overweight those rate-sensitive sectors you mentioned, so real estate, staples, as a bond proxy. Construction, we think, is going to do a great job. We just downgraded utilities after the great outperformance. Next up is consumer. In my view, there are 3 things that you need for the consumer in Europe to be spending more. That's lower rates. We're in the midst of a rate cutting cycle. We think ECB will cut over 1% until April. You need higher wages. If you look at Germany, wage growth is 6%. Despite all this negative news, wage growth is pretty solid. We're expecting more than 3% next year for the Eurozone. So wage growth, check, right? You need higher wages to be spending more. And then third is consumer confidence. And although it might not feel like that, consumer confidence has been picking up for 2 years in Europe already and is back to normal. Now, at the same time, savings rate is around 15%, which is the highest outside of COVID. So we think just by savings rates coming back down, we'll have a consumer spree in Europe.
OK, so you think there's room for the consumer to step up then in Europe, and part of it, as you say there, due to real wages. But in terms of, Max, in terms of that real wages story, it seems we've been sitting on that for quite a while, actually. But psychologically, it seems to take a while to cut through. You still hear talk of cost of living crisis in various parts of Europe, even though inflation has really faded and wages are much higher in many places, as you point out. But prices are still elevated versus pre-COVID. If people are waiting for them to go back down again, they'll be waiting a long time. But it seems psychologically it takes a long time for the consumer to buy into this trend that you describe.
Yeah, right. It takes a long time, right? And we think we're now at this turning point because what's happening now is rate cuts. And if you have 4% and you get on your deposit, right, you probably put more in your savings account. If that comes down to 2%, probably going to spend a little bit more. But I agree. So it takes longer than we expected. But don't, mistake real wages for nominal wages. Nominal wages have been growing for a while. Real wages have just been picking up over the last 2 quarters. So that's a trend that's just emerging now. Agreed, takes longer than expected, but happening.
Maximilian, let me ask you about your favourite index, the FTSE, having a good old day today off the back of those CPI numbers. Is there anything that Chancellor Rachel Reeves could do on October the 30th that would change your mind about that?
Actually, I think there's plenty of reasons that make me more positive about the FTSE than the rest of Europe. And you've seen today's market move, right? You have this great volatility in Europe ex-UK and UK stable again. So we have our preferred sectors are very well represented in the FTSE. We think political risk in the UK is actually lower than in the rest of Europe. If you compare the budget problems that the UK is having, we have bigger problems in France. We have similar problems for a different reason in Germany. So I think, relatively speaking, the FTSE is the most attractive. Higher staples exposure, zero tech, very low luxury exposure. So I think sector performance, political risk, plus CPI numbers yesterday, for example, giving a good background.
What about the political risk in the US? Kriti, eager to find out how to trade it and when you can trade it. I'm thinking potentially about the impact on luxury names of tariffs. Could we see them there?
Certainly can. If I may repeat that, probably the FTSE is going to be the one most exempt from those tariffs, because usually those are targeted at the Eurozone, right? So again, maybe one reason to be more positive on FTSE, we'll have those tariffs if Trump wins. You had the interview yesterday on Bloomberg, right? He's been mentioning tariffs again and again and again. We don't think it's a game changer, but it's certainly not good news.
You mentioned, I'm going to take it away from tariffs for a moment and bring it right back to a point you made earlier on construction. You said you were positive on construction, and there's really only a bull case I've heard around the periphery where so much of that construction is funded by fiscal spend from governments. Is that the case around construction?
It's really residential construction. That's, I think, one big driver, right? If you look at Germany, for example, 10% of German GDP is construction. And that's been coming down over the last two years, in our estimates, by 15%. So you could say 1.5% of GDP negative growth in Germany, for example, is due to construction. Now, that's been coming down also because of higher rates. At those rates levels, people don't want to be building houses because buying something or renting something is cheaper. That dynamic changes a lot over the coming month. So they already have high order books, and with lower rates, those order books are probably going to be even bigger, leading to more profits.
Let's see if that sticks. It certainly doesn't look like it in the markets at the moment, but maybe things will change. Maximilian Uleer, head of European Equity and Cross-Asset Strategy over at Deutsche Bank, joining us this morning. I get the fun task of doing the Sensational Six today, and the market moves around. Some of these names are indeed sensational. Take a look at LVMH. Take a look at ASML. Brutal numbers there. A whopping 6% decline on LVMH, 4% for ASML. Novo Nordisk having a good day. They're looking at its peers and really smiling. Higher by about 0.8%. One of your biggest index contributors to the upside, but really not stemming the losses you're seeing in LVMH and ASML. I think it's just worth going through some of the other pain that we're seeing in this market this morning. Let's get a read on that with Joe Easton from our equities team. Joe.
So brutal really is a good word to describe it this morning, Kriti. We're seeing all of these luxury stocks dropping. LVMH was down 7.5% at the open. You had to go back to the COVID outbreak of 2020 to see a closing price as sharply down as that for LVMH. And we're also seeing peers like Kering coming down. Bear in mind, this stock already down around 40% this year, down another 5%. Hermes in France as well, and then spreading it over to Switzerland. We're seeing Richemont, one of the more defensive companies in the space, dropping as well. And we are seeing a broader read across into other countries as well in terms of some luxury movers. We had some decliners over in, well, here in London, Burberry down 4%. Moncler in Italy, and we mentioned the drink stocks as well. Remy Cointreau falling 2%. That one hit. We also saw Diageo lower. Pernod Ricard fell as well. And finally, over in Italy, bear in mind, Salvatore Ferragamo, they did actually have their own little profit warning yesterday, kind of wiped out by the LVMH news, but really adding to the gloom in that one today. And we will flip over and have a look at some of the UK shares. Well, first of all, here are the semis. We can't forget about those. Now, this is also pretty striking. ASML fell 15% yesterday, and it's down another 4% today, down 19% on 2 days, the biggest two-day decline since 2002 for that stock. So really massive moves on there, and seeing the read-through. Once again, these shares declining, adding to the losses we saw late yesterday. Some had expected a bit of a rebound, but BE Semi, VET, Soitec, all of those names coming down. Then we will go to the UK because this one's standing out given the CPI data, and we are seeing positivity in this market. One of the few markets seeing gain today. Taylor Wimpey, mortgage rates coming down potentially with what we all want to see, and that is boosting the home builders. Lloyd's getting a bit of an uptick, although it is unclear whether the rates coming down is actually good or bad for banks these days. In utility, Centrica coming up, given the bond yield relationship, and the high street retailer next getting a little uptick as well. Will we see another Bank of England rate cut next month? We'll have to wait and see, but we are seeing positivity on that. Then in terms of earnings today, we have got Adidas. Now, Adidas, everyone said that was good, but I think the LVMH news really just wiping out all the positivity in fashion stocks today. Premier Inn, though, doing well. A bit of green on the screen, finally. Well, that's what we like to see in the UK for the hotelier, the best performer in Europe today, only up 2%, kind of telling us how bad the market is at looking at the morning. And we had some profit warnings. One was Rexall, we mentioned in stocks to watch. That's electrical components and Just Eat takeaway. The Americans not buying enough takeaways, according to their report. That's over in the Amsterdam Exchange. Finally, we're going to take a look at L'Oreal, because this one getting absolutely slammed because JP Morgan went underweight. That was down on 8% at the open. It's come back up a little bit now. JP Morgan underweight, but also LVMH really hitting every stock in that sector as well. So that one declining, adding to the woes following JP Morgan going underweight L'Oreal this morning.
Joe, thank you. Joe Easton with a very busy day from our equities team, running us through some of the stories from yesterday evening that linger on into this morning and some of the new news we need to factor in. And some of that comes from the luxury space, of course. Coming up, LVMH shares falling then, as Joe's been telling us, after reporting a slump in sales as the luxury industry's biggest player is hammered by a drop in demand from Chinese consumers. We will dig into the details. We'll get an update from Paris shortly. This is Bloomberg. Welcome back to the opening trade. Well, this is the picture across European equity markets right now. We see some divergence. The FTSE 100 then benefiting from the weakness in the pound, and so that stands out to the upside, up by 0.7%. Elsewhere, the CAC 40 really under pressure, down by 1%. The DAX down 0.3%. To sum up some of the headwinds that we have being thrown at these markets, let's just have a look at some of the themes we're dealing with right now, and many of them coming to us from China, but they take different forms. In the luxury space, we seem to have some consumer stocks that are struggling, and the luxury side of things very much in focus there. LVMH is the poster child for that right now. That's weighing on Kering and others, though. We also have geopolitics playing in, and the difficulties for ASML and the like of selling into the Chinese market. Perhaps that's something we'll learn more about later on today when we get that investor call from ASML. It really shocked the market yesterday with its update. Came earlier than anticipated, but certainly China and an understanding of the geopolitics, one of the things we want to find out from ASML. And then China crosswinds also hurting the auto sector, although the overnight news really more around Stellantis in North America. But we do have, of course, this ongoing focus on what China and relationships with China and the geopolitics as it plays out is doing some of these consumer brands here in Europe. Let us focus on the first of those, and that's the luxury side. LVMH shares have slumped after the French luxury giant reported a fall in sales of fashion and leather goods for the first time since the pandemic. For more, we're joined now by Bloomberg's Caroline Conan, who's in Paris. Caroline, take us through then how bad things are getting for LVMH.
After years of shine for this luxury sector, clearly even the biggest brands such as Louis Vuitton, Christian Dior are not resisting the slowdown. The overall revenue at LVMH in the third quarter is down 3%. They missed basically on every single unit. Let's talk first about their biggest one, fashion and leather, which of course includes Louis Vuitton, down 5%. That's much worse than expected. It's actually the first actual drop since the pandemic. The aspirational consumer clearly is not back, and the Chinese, of course, is still very reluctant to spend given the problems they have there, especially in the property sector. And the stimulus that we've seen recently in China is clearly not yet reflected in these third quarter numbers. Asia, excluding Japan, is down 16% in the third quarter, and that region alone is 1/3 of LVMH global sales. So that kind of gives you an idea of the impact it can have on LVMH globally. We heard from the CFO, Guillaume, last night in the analyst call, who actually said that consumer confidence in mainland China is now at an all-time low reached during COVID. Japan also was impacted by the stronger yen. Chinese consumers not going to Japan to do their luxury shopping. Things are not getting better in other divisions of LVMH. Obviously, watches and jewelry down 4%, even though Chaumet was actually the maker of the Olympic medal. So they had a lot of visibility, of course, in the third quarter. And it's not only China, it's also the US. US consumers, analysts were expecting a pickup in the US. In fact, LVMH didn't grow at all in the third quarter in the US. US consumers buying less champagne, less cognac, and cognac producers, of course, things are not going to get any better there given the new tariffs from China on cognac producers.
All right, Bloomberg's Caroline Connin in Paris, we thank you. And I want to continue this China theme and take it to ASML, which is compounding yesterday's losses off the back of those results. Dropped early, of course, yesterday. We were expecting them this morning, but down 17% in 2 days now, having opened lower this morning, down 5% just this morning. They had this tepid outlook, sparking a global rout in the sector yesterday. Losses of more than $420 billion. But let's get more info now from Bloomberg's Sarah Jacobs in Amsterdam. Sarah, how much is this story about tariffs? How much is it about uneven demand? And most importantly, when are we going to find out whether it was because they got this early result from fat fingers or the intern?
Good morning. Yes, you're right. ASML published their third quarter earnings a day earlier. We were expecting it to hit at 7 a.m. this morning, but it came in last evening. The company cited a technical error for yesterday. In terms of results, yes, bookings missed estimates. The bookings came in about the orders came in about half of what analysts had anticipated. They cut guidance for next year for net sales and gross margin. So a surprising slowdown for Europe's most valuable tech company. ASML's CEO said it appears, in a statement yesterday, he said it appears that the recovery is more gradual than they had expected, that it will continue into 2025, leading to customers' cautiousness. So we'll have to hear more about why this happened and what it looks like over the next year during the earnings call at 3 p.m. today.
All right, so Sarah, I'm going to put you on the spot here. What else are we looking for? Is this kind of the worst that it could get for ASML, or is there more pain to come?
Well, we'll have to see what they say. Of course, pointing out that analysts are also investors are looking at the November 14th day, which is the ASML's Investor Day, where they are going to talk about long-term scenarios for, lithography demand and, their outlook as well. So in terms of how things go from there, that's another important day for the company. But of course, based on what they said yesterday, weakness in ASML's orders often signals struggles for the entire or the wider chip sector. ASML is seen as a bellwether of sorts in the chip industry because its machines are used to make, the most advanced chips, and it has clients like TSMC and Intel. So it's a big miss is a signal that, the chip industry's weakness is possibly set to continue.
Yeah. Certainly something we're going to be keeping a close eye on. The ripple effects from China certainly getting broader and broader. Bloomberg's Sarah Jacob joining us out of Amsterdam. We thank you so much for giving us that crucial insight on those ASML numbers. Coming up, with the global easing cycle firmly underway, AIB's Colin Hunt is going to be giving us his take on bank profitability and more. That conversation next. Stick with us. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session. You're looking at the Stock 600 lower 0.25% this morning. The underperformer is the CAC 40 lower 0.7%. What's weighing on that is luxury. LVMH lower more than 5% this morning, and that hitting names across the sector. Kering, Burberry, Hermes even this morning. But also we're seeing the ASML impact. That stock down even more this morning off the back of their earnings yesterday. 4.2% down this morning.
Yeah, really incredible moves in ASML, aren't they, over the 2-day period? Because after that 16% drop yesterday, you wondered how much of that was sort of in panic at the early release and how much of that would be sustained into today's session. Well, the answer is all of it and then some. So we'll wait to see what details we get in the call. I think that's going to be really interesting, that investor call later. What exactly is it? Who exactly is it that's holding off on orders? Which sector of their business is coming under pressure? And then we can establish really the read across into other businesses.
I don't even know which one is worse here, because if we're kind of pointing the finger at China for both of them. For LVMH, it is a Chinese consumer story. It's a broader kind of demographic that they're trying to reach or that they're trying to encourage. For ASML, those machines are very expensive. It's a handful of customers that even if they decrease a couple of orders has a pretty material impact to their business. So it's an interesting way to talk about who is actually making this difference. It's not the only market move we're watching. The UK assets are moving quite a bit as well, which is where we started our program on CPI, 129 handle on cable.
Yeah, absolutely. So the weakness in the pound actually supporting the FTSE 100, of course. You see that often. And the FTSE is up by 0.7%, standing out to the upside. Although I should say the Ibex over in Spain also a little stronger this morning. Something else that is stronger is banking stocks out of Italy, which is of interest when we go to our next conversation. Bloomberg understands Italy's government plans to raise 3.5 billion euros by tapping the country's banks and insurers to help finance the budget. Prime Minister Giorgia Meloni says the money raised would be allocated to healthcare and the most vulnerable. Joining us now with an update, Bloomberg's Alessandro Migliaccio, who's been covering the budget story out of Italy for us. How big is Meloni's budget plan then? What does it cover here?
So late last night, the cabinet passed the budget plan, which then has to go to the EU and then will go to the Italian parliament for approval. And from what they told us, and here's the thing, they didn't tell us much. It's a bit unclear, but it seems like they said 30 billion gross. All right, so that 30 billion gross covers a lot of different things. We're talking about aid to families. We're talking about huge tax cuts on wages, on the tax wedge. We're talking about healthcare, as you mentioned before, lots and lots of things. And they didn't really tell us how they're going to pay for it. They did tell us one thing. They told us banks will play a role in paying for it. And it's what they're paying for is about 3.5 billion. Now, you can see that it's 3.5 billion out of 30. I guess they got away easy is one way to put it. You know, they will be paying a bit more, but it looks like it's 3.5 billion over 2 years. We've heard from sources. And it's really not that much to cover that huge budget. So I think compared to what Meloni had said about banks, how they've been profiting from high interest rates and they need to contribute more, they're not contributing that much. So in a way, it went well for banks.
In terms of some of those banks, it looks like 3.5 billion euros over 2 years. Doesn't seem like that much. Can you just put those numbers into context for us?
Right. So, yes, it's a very weird number for us. I mean, as we were looking at it with analysts and we're talking to some economists, and it looks like it's going to be in deferred tax assets as well. So that's interesting. That means that I guess they will pay a bit more now and over 2 years again. So we're looking at maybe 1.7 billion in 2025 and then another 1.75 in 2026. Really not that much. And if it's deferred tax assets, as we were told, the government has not yet confirmed this, then, you know, they pay a bit more now, but in the long run, they'll pay less going forward. So again, they're not really paying this money. So the banks, you know, last year, the government was really trying to get the banks to pay. It looks like they haven't found a legal solution that the banks you know, would fight any option, anything that the government does to strike just the banks. Legally would be complicated. They've never really succeeded in the past. So that's the reason why they're unable to do what they're trying to do. But it'll be interesting to see. There's a press conference today at 11, so we'll be asking those questions, you know, to the Italian finance minister.
All right, Bloomberg's Alessandra Migliaccio, we thank you for making sense of the few details we have got from Giorgia Meloni there. And I want to continue this conversation on the impact of European budgets on European banks. We can talk now to Colin Hunt, CEO of the Irish bank group AIB Group. Lovely to have you with us in the studio, Colin. We got the Irish budget at the start of the month. The sale of AIB shares giving the government more cash for infrastructure upgrades. The obvious question is, are there going to be more state share sales in 2025?
Well, we've seen quite a significant decline in the government's shareholding in AIB over the course of the past number of years. They started with an IPO process in 2017, then paused and resumed using ABBs, DBBs and a trading plan to reduce the shareholding in the company, and it's come from 71% down to just less than 21% over the course of the past almost 3 years. We very much welcome the fact that we've seen the monies from AIB that we've generated this year for the state, about €3 billion, being ring-fenced for critical infrastructure development in housing, in water and in electricity. And look, my job is to ensure, along with my colleagues, that there's a strong investment proposition in the market when the government decides to transact. But ultimately, it's the government's decision. It is, though, within the bounds of possibility that we will see the Irish government exiting the share register in calendar 25.
But do we have more detail on the kind of time frame for that exit?
Well, the government's trading plan is running. That clips at about 1% a month. There is this year we did a directed buyback on foot of our annual results, which we announced at the start of March. We did a further directed buyback, 1.5 billion in total, when we announced our interims. And let's wait and see what we have to say when we get to announce our full year results. But I'm concentrating on closing out 24 for the moment. Let's wait and see how we end the year, and then very much look forward to bringing that news to market in the opening weeks, probably of March.
OK, so it's in the bounds of possibility that we see the government reduce that stake more than in 2025. Colin, this story goes back such a long way, doesn't it? You know, we remember when governments around Europe were taking stakes in banks, and now we've seen, in quite short order, governments in Ireland, the UK, Germany, the Netherlands, Greece, all selling off their stakes. Obviously, higher interest rates, more profitability for the banking sector help there. Are you surprised how long it has taken us to move on from the financial crisis in the sense of government ownership of banks across Europe?
I'm not overly surprised, to be honest with you, because the scale of damage done to the financial system during the global financial crisis was so great that it required a long period of time to correct the damage. So at AIB, we've been focused on reducing our non-performing exposures, dealing with legacy issues, cleaning up our loan book, building a better, stronger bank, building a better balance sheet. And we've done that. And now we have a very, very strong investment proposition to bring to the market, and the government is making use of that in reducing its exposures. But I'm not overly surprised it's taken this long.
OK, well, one of the other legacies of the financial crisis is a cap on bonuses in some parts of Europe. Now, the UK's got rid of that, but much of it still remains. And I know you've spoken in the past about it having an impact on your ability to seek and retain talent. Are you still seeing it having an impact on departures?
Yes, it is. Yeah,
especially to the UK, perhaps?
No, within Ireland largely, because the restrictions as they are in Ireland, in terms of the bonus restrictions, apply to the bailed-out institutions rather than the broader industry. But we are seeing an ongoing impact of it. And if you have a situation where even somebody in their early career looks at opportunities of joining a company with unrestricted remuneration and a company with restricted remuneration, it's not unreasonable to expect that individual to make a decision that creates greater earning opportunities for them over the medium term. But it does create an uneven playing field, and certainly we have to work extra hard to ensure that our employee value proposition is strong in the market to recruit and retain.
So have you been talking to the finance department? Have they given you any hints that salary cap could be lifted now that their stake is lower?
Well, I don't engage in those conversations with the Department of Finance. That is a matter for the board of AIB, and the board of AIB has been in correspondence, which is public, with the government over the course of the past 15 months or so on this topic. But my focus is very much on ensuring the bank is delivering for all its stakeholders and as well run as possible.
Well, speaking of things going on and conversations happening at the finance department, talk to us about taxes, the really juicy stuff here. I believe in the last 24 hours, a proposal has been made in Ireland to have even more tax-friendly policies for businesses. Certainly something that I think a lot of corporates around the world are kind of perking their ears up at, given what you're hearing in France, the UK, and potentially in the United States in a couple of months. Is that going to show up in your bottom line, any of those kind of business-friendly proposals that they have?
Well, I think that Ireland has been a very attractive destination for foreign direct investment, and certainly taxation has played a role, but it's only played a role, and there are other dimensions to Ireland's attractions as a destination for foreign direct investment, including open, unfettered access to the largest single market in the world, in the European Union, and certainly the pro-business approach of government, the stability of government policy, and the taxation arrangements have proved beneficial in seeking to attract foreign direct investment, particularly from the United States. And we now have a very, very nice industrial cluster built in technology and digital.
The poster child of that dynamic that you're just talking about in terms of attracting that foreign direct investment seems to be Apple. I won't ask you about Apple specifically, but you made that comment that Ireland is the gateway to the European Union. In the last month or so, you've had a top court at the EU say, well, actually, Apple owes back taxes to Ireland. So that kind of tax haven, that business-friendly policy, maybe there just didn't exist. Do you think that changes the view for corporates like Apple who were looking at Ireland and are maybe reconsidering?
Well, I think in this particular case, this relates to legacy taxation issues. This court case was running for the best part of 10 years. During that 10 years, we've seen an extraordinary performance in terms of FDI flows into Ireland. So certainly, as the court case was running, there was no impact, no detrimental impact on those flows. Ireland is fully compliant with the OECD BEPS. We've recently raised our corporation tax rate on large corporates from 12.5% to 15%. But I do think that the key thing here is policy stability, policy certainty, and that genuine pro-business approach.
So that's the Irish side of things and what's in control of the Irish government. But then there's the other factors as well, which is that the corporate tax rate, the capital gains tax rate, among other not business-friendly kind of circumstances are existing in France, certainly potentially in the UK, windfall taxes in the periphery, not to mention the election in the States. Do you see this idea that were we to hypothetically see a higher tax rate show up in the United States, you would see even more flows into Ireland?
Well, the indications are at the moment that we are going to see a lower flow going forward than we've had in the past. And that's not necessarily problematic, given the fact that we've seen a 17% increase in employment in Ireland since the 1st of January 2020. So not only have we recouped all those COVID losses, but we've actually moved well beyond an extraordinary performance in terms of employment growth. And the economy is operating at pretty close to full capacity. But that said, leaving aside the taxation issue, which is an important feature, there are multiple factors in driving Ireland's attractions as a location for FDI, not least, as I said already, open, unfettered access to the European single market, the only English-speaking common law country that offers that.
Yeah, and Colin, that's interesting. Takes us to a conversation perhaps about commercial real estate and your exposure there in Ireland. That's one area that maybe has been supported by some of these big US multinationals locating there. Do you see, but some people are nervous in many geographies about CRE post-COVID. Are you nervous about the commercial real estate picture that you see and your exposure to that?
Well, I would have been more nervous during the rapid tightening phase of monetary policy because it's going to have an impact on yields, and as yields go up, underlying valuations are going to come down. And certainly we took a forward-looking, cautious approach to our CRE lending in the past number of years. We haven't lent into the United States. Our heaviest exposures are obviously in Ireland. We have some exposures here in the United Kingdom. Very, very conservative underwriting standards. I suppose the shadow of the GFC and the shadow of AIB's performance during the GFC is still very much being felt. So we don't lend LTVs in CRE above 60%. And what we've done is we've taken a very conservative approach to our provisioning in this space. And looking at 2023, I think we took a provision in CRE of about 280 million, the bulk of which came from a post-model adjustment. So it wasn't a specific case or a specific troubled case, it was our general view on the marketplace. So we're very, very strongly provisioned. In fact, in the first half of this year, we saw some stage 2 cases moving back to stage 1.
OK, interesting stuff, Colin. Thank you very much. Thanks for joining us this morning. Well, he passed through London. Colin Hunt, the CEO of the Irish bank AIB Group. Coming up on the programme, Donald Trump dismisses criticism of his tariff plans just 3 weeks out from the US election. More from our interview with the Republican presidential nominee and former president. That's next. This is Bloomberg.
I had 4 years no inflation. I had 4 years no inflation.
But that was when you had much.
I had 4 years. It's better than that. And Biden, who has no idea where the hell he is, okay? Biden went 2 years with no inflation because he inherited from me. And then they started spending money like drunken sailors. They spent so much money. It was so ridiculous, the money they were spending. They were spending on the Green New Scam. The Green New Deal. You know, it was conceived of by AOC +3. She never even studied the environment in college. She went to a nice college. She came out, she just said, the Green New Scam. She just named all these things.
But President Trump, the issue at the moment, the markets are looking at the fact you are making all these promises. Latest one was car loans. You're flooding the thing with giving giveaways.
But we're going to grow.
I was actually quite kind to you. I used 7 trillion. The upper estimate is 15 trillion. People like the Wall Street Journal, who's hardly a communist organization,
yeah, but you don't know.
They have criticized you on this as well. You are running up enormous debt.
What does the Wall Street Journal know? I'm meeting with them tomorrow. What does the Wall Street Journal know? They've been wrong about everything. So have you, by the way. You've been wrong about
You're trying to turn this. You're trying to turn this.
You've been wrong.
No, you're trying to turn this into debate. There are business people.
But you're wrong. You've been wrong. You've been wrong all your life on this stuff. You've been wrong. Let me tell you about currency. You're going to jump in a lot of different subjects.
Whilst you're sticking to the subject very closely.
Let's stick to reserve currency. That's where you started, right? The reserve currency is under threat because you have Iran, you have Russia, you have China. China's the one that you have to worry about because they want it.
Yeah.
They want to have the yuan be the thing of power. So here's what I'm doing. Again, I hate to go back to it. If somebody says, and I know countries want to get out because they don't respect our leadership, they look at this guy, they say, you got to be kidding, and she's worse than him. By the way, I never thought I'd say this. She is not as smart as Biden, if you can believe it. This is not what, we had 4 years of this lunacy, and we can't have it anymore. We're not going to have a country left. Okay, currency, very important.
Yes.
And if you want to go to third world status, lose your reserve currency. We have to have that. We cannot lose it. If you'll go to third world status in this country because you take a look at the way things are running. If a country tells me, sir, we like you very much, but we're going to no longer adhere to being in the reserve currency. We're not going to salute the dollar anymore. I'll say that's okay. And you're going to pay a 100% tariff on everything you sell into the United States. And we love your product. I hope you sell a lot of it into the United States, but you're going to pay 100% tariff. He will then follow it up by saying, sir, it would be an honor to stay with the reserve currency. That will be like just playing. That's not even chess, that's checkers.
Republican presidential candidate and former President Donald Trump speaking with our editor-in-chief, John Micklethwaite. And I think there was a lot that happened in that discussion. But I think the key takeaway for me has been that he's sticking really to this plan that there's a deficit that's running in the United States right now. The way to fund it, or the way to close that gap in the face of tax cuts that he wants to extend into a potential second term, is tariffs, and that's the answer to that. The issue here is that it's all on the condition of bringing back manufacturing to the United States, which is why his 15% corporate tax rate is contingent on if you produce in the United States, just as tariffs are contingent on your exposure there. Does that help solve the U.S. budget problems is going to be a key question.
Yeah, absolutely. I mean, he believes in that strategy. Many economists point to the risks of retaliation, point to all kinds of other risk factors, the risk around higher inflation. Interestingly, he brought up a lot of subjects just in that short clip we showed there, and there were many more of them. But we have a nice explainer on the Bloomberg terminal about some of his remarks on the economy and sort of taking the longer view, giving them some context that they needed around tariffs, around budget deficits, all kinds of policy areas that he referenced there. But it's interesting to think about where retaliation might happen in Europe then, Lizzy, if we did see further tariffs on European product. Just cast your mind back to Trump 1.0 and we saw Europe aiming at things like Harley-Davidson and Levi's. And you can see from our reporting overnight that Europe is once again drawing up lists of which companies it might target.
Yeah, and it could be a bigger impact here between the US-EU relationship than the US-China relationship, as our guest from RAND said earlier.
OK, let's talk about where we are on the banking sector right now. The most volatile quarter since the pandemic delivered a windfall to Wall Street's trading desks. The likes of Goldman, Bank of America, Citi and JP Morgan all posted equities and fixed income trading hauls that beat analyst estimates. Though Citi's net interest income and margins fell short for the street, and there was a lot more to unpack around Citi as well. Let's talk to Charlie Wells, who joins us now. So, Charlie, let's stick with the big picture story. What seems to be the driving factor behind the US bank's blowout quarter? A lot of them doing quite well.
A couple of features here, and I think when you tuned into those executive calls on earnings yesterday, you heard David Solomon of Goldman and Jane Fraser talk about how good the economy is doing right now. You heard Jane Fraser say something like, whatever you want to call the landing, it's optimistic. And so that is creating an environment that's great for banks. The lower rates are actually helping as well, because you get this sentiment of, you know, deal pipelines becoming healthier than they have been in a long time. And also, as you mentioned, volatility. That has been really good. So against this backdrop of a strong market, you have volatility that makes players want to take part in that market and makes money.
let's talk about that volatility. So much of that trading revenue has really helped, to your point, to prop up some of these bank results. Morgan Stanley is a little bit of a different story. We're getting results from them later today. But to them, it's kind of this wealth effect, right? Because of their wealth business. E-Trade as well was their major business that they had acquired. Does this change the narrative around banks, what we hear from Morgan Stanley today?
Well, it's going to be really striking because they have positioned themselves so squarely in that wealth corner. And I think from one perspective, the rise in equities should be beneficial for them, right? That should potentially bring that wealth, revenue up higher. But also, they are also positioned in that investment banking space, and we've seen banks that are more kind of positioned there, like Goldman, have really positive revenue on the investment banking front. So if Morgan Stanley, in just a few hours, can kind of bring in that strong wealth front, if they can also bring in that strong investment banking front, they should have some pretty solid results.
All right, Charlie Wells taking us through those bank earnings and looking ahead as well. Thank you for that. I just have to take us right back to where we started this programme, which is UK CPI. So we got undershoots at the headline core and services levels. And the reaction in gilts is really striking. The 2-year gilt yield lower 9 basis points at 4.03%. The 10-year lower 7 basis points at 4.09%. I think that's the lowest since October the 4th, if not lower. And actually, interesting commentary from Vander's Viraj Patel. He points out it's not just that CPI missed. This was one of the weakest September month-on-month prints for core over the last 25 years. And what's really interesting is he says it opens the door to a 50 basis point BOE cut in November.
Yes, and it's below the Bank of England's own estimates, isn't it, this reading on inflation? And that could be material when you're thinking about the read across from this number, whether it gives that green light for further cutting. And you were saying earlier, the market thinks November, but now the question is whether we get December as well then. That's the question for markets.
Well, we had Jane Foley as well on this program, really talking about it's all relative, it's all respective. Context is everything, for lack of a better term. But I think what's crucial here is that even with that decline, even with potential 50 basis points getting back into the equation, you're looking at cable at 130. You are still looking at strength relative to the euro, to the Swiss franc as well. We had this conversation over and over again on the show, basically saying that, yes, things are tough here in the UK, but relative to what's going on in France and Italy, etc., things may not be that bad. And I think that's really quite striking.
Yeah, interesting to link the currency then with what we see on the stock market then, Lizzy, because we see UK stocks doing pretty well this morning, up by 0.8%. Weakness in the currency, of course, if you're earning dollars overseas, that can help you when you translate that back into pounds. And so there's a sort of a knee-jerk read across there. And so the repricing of what's likely to happen at the Bank of England as a result of the weakness in this inflation data having an impact on a whole host of asset classes this morning. No doubt they'll pick up on the UK theme during the Pulse. That's up next. They'll have plenty to talk about, plenty of stories to choose between. ASML, LVMH, lots to discuss. This is Bloomberg.